Today's pullback cannot be called that. It is a tepid kind of a pullback, so it would keep the trader guessing on whether yesterday signaled a reversal to the intermediate uptrend, or indeed it was just a pause, and today the rebuilding process has started once again. Let's go and put all these questions to Ramesh Damani, who's just joined in after many weeks. Ramesh, morning. Good to see you again. What have you made of the last few weeks where we've had a fairly spectacular and sharp 25% rally?
Good morning, Udyan. The bad news, of course, is that it is a bear market rally. The good news, Udyan, is that you can view the market from many prisms. You can view it from earnings, from expectations, from decoupling theory. But if you view it purely from the angle of sentiment, I've never seen the bears more confident in the 25 years I've been watching the markets. I mean, the way they're talking is like Armageddon 2 is going to happen, and it's going to happen tomorrow. And markets rarely oblige in that direction. So if I were going to stick out and make a call, knowing how fraught it is with danger, I would say the market is not going to go back to the bottom of its trading range in a hurry. It's going to spend some time at the higher end of the trading range, maybe even take out 10,500. I just think the confidence in the bears is so supreme that the market will test them also.
But eventually, after the scare that you're predicting for the bears, do you think it will still remain a bear market, in which case that recent lows of 2,500 Nifty still stand under threat of a retest or a breach? Or do you think we've passed that fear?
Well, then, unfortunately, no. I think if you go back and study the evidence of any great bull market in the history of the world, it really makes a bottom in the first year of its lows. I think it's a very long and a very painful period ahead of us. I don't want to, play light on that prospects, because we are still in a bear market, and this has all the symptoms of a classic bear market rally. Only a small leadership advancing, absolutely giving you no time to think. Bear markets are very, very painful, and the market will eventually break the 8,000 barrier. A very good chance it will test and break the lows, but I don't think it's going to happen in the next, say, 1, 2, 3 months.
Ramesh, morning. You do see it happening, though, at some time in 2009. And what makes you less willing to subscribe to the theory that perhaps equity markets or Indian markets have seen the worst in terms of a bottom for this year?
I think, if you ask the bulls, and, the theory they advance to you is that India is different, okay, that we have a great domestic economy growing, our GDP growth will be somewhere north of 5%, and all that's probably true. The problem is that markets don't change. Markets are never different. And I think if you go back and study, Mitali, any of the great bull markets in history, whether it's Japan or the US bull markets in 1968 or Thailand or Taiwan, once that bull market ends, the forces that propelled it higher end, there's a huge, huge time for the market to regain its old highs. And when I'm talking about a new bull market beginning, I think we have to take out 21,000 to take that seriously. And that might not happen for another 5 years, to be optimistic, because that's just the kind of pain that the markets inflict. I think there'll be a whole generation of people who will forget about investing. We'll have to get to that kind of sentiment level. I mean, both the bulls and the bears, when this rally happened over the last week, the bulls were, supremely confident that the worst was over, the worst is in the prices. Yesterday it was the bears. I think the market will, tend to make both of them complacent before it moves out in either direction. But if you look at the historical evidence, it's absolutely clear-cut. In fact, there's no dispute in my mind that we are in a bear market. This is a bear market rally, and ultimately the market will test its lows and break it. It's just not going to do it in a hurry as the bears think.
If you were to look at the market through the prism of economic data, though, Ramesh, how are you feeling about that? Because the catalyst, if you may, for this bear market rally we've had was that maybe things were coming into place in the financials. Maybe the data wasn't going to be as bad as what we lived through in 2008.
The data can be looked at, so many different ways. I mean, you can say that auto sales were up, so that's a good indicator of a cyclical recovery. So yes, the bad news is behind us. So the cement prices are up. That's a good leading indicator. So yes, the economic recovery is ahead of us. But, I can give you equal data to argue the bearish point of view. I give you, the first time you're talking about, we always heard about the first world, the second world, and the third world. The first world being, of course, the nuclear superpowers who are rich in Western industrialized economies. But you don't have to look at them anymore. I mean, you have a country like Britain who's basically teetering on the edge of insolvency, So the whole world, in terms of those analysis look pretty grim. You're going to have an economic contraction in the world, back-to-back the worst economic contraction in the U.S. While equity markets have rallied, what a lot of analysts are pointing out is the credit markets are still pricing in a very high risk of defaults. So I think the global economic picture means that global economy is going to slow down, and that's generally not good for stock markets. And besides, even if the economy does well, the markets don't have to do well. There's no law that says if GDP growth is 6%, the market will perform at 12% or some number like that. So I think it is actually wishful thinking to think that the market can go back to 21,000 in a year or 2 years. I would rate that as a very small chance, very small probability of that happening.
So where do you see upsides capped for 2009, Ramesh? What is that point at which point bears start throwing in the towel and saying maybe things are changing and we should not be so complacent about the downside risk in the market, and the point where the bull starts saying that things have turned once again for the mint? Is it 10? Is it 10? Is it 11? Is it 12,000? What is the upper limit in your eyes?
A few months ago, I would have said 10,500. That was the day the Satyam debacle broke. It was, around 10,500. My sense is the market will take it out and, go up to, say, between a broad band with 11,500 and 12,500. 12,700, if you remember, then represents the peak it reached in May 2006, before the market had one of those most ferocious bull market falls. So I would say 12,700 or spikes around that region would be the higher end of the range. It may never get there, but I would be, if it crossed, say, 12,700 in a very decisive manner, you would certainly have to look and say that maybe your analysis needs to be rethought out.
Let's take a break. When we come back, there's much more to talk about with Ramesh Damani. But we will talk elections, because that's another important event which is on which the market outcome might hinge.